7 assets to own if you want to grow wealth. Do you ever wonder what it takes to become wealthy? What do successful people know about building wealth that many others do not? The rich understand the difference between assets and liabilities and choose to invest in income-generating assets. But before I get too far along, let me define asset and liability for those of you unfamiliar with the terms. Assets put money into your pocket. Liabilities drain your wallet. Assets make you wealthy. Liabilities make you poor. The more assets you own, the richer you are. Now that we have that out of the way, here are 7 assets to own if you want to grow wealth. This is Financially Well. Hit the subscribe button you see below and like this video to get the most out of your money. Number 1, good old cash. You might think this does not really fit in, especially nowadays when the interest paid on savings, CDs, and money market accounts are not keeping up with inflation. But you are wrong in your assumption. Let me give you 2 reasons why the rich hold a sizable portion of their assets in cash and cash equivalents. The first is so that they'll be ready to take advantage of money-making opportunities when they present. Think about it for a second. You need liquid cash to capitalize on opportunities when they come along. And the second reason why the rich hold on to liquid cash is that they can get higher return or better prices on straight cash deals. This is true in real estate and in the automobile market. Cash buyers are often given discounts because the sellers get to avoid the cost and time associated with financing the deal. If you're a real estate investor, the savings and return on your investment could be huge. Number 2, real estate. It is hard to go wrong here. Many investors made their millions through real estate. It is one of the best vehicles to grow wealth for several reasons. First, there will always be a demand for housing as people need a place to live. There has virtually always been a housing shortage, with the present deficit hitting record lows just last year. Second, real estate investment nearly always increase in value. This is called appreciation. If you're thinking about becoming a real estate investor or building wealth for that matter, a good place to start is owning your own home. However, you must bear in mind that if you happen to live in a high-priced urban area, the cost of home ownership may outstrip the cost of rent. When you own rental properties, you can get a handsome rent check that helps you pay down your mortgage each month. Furthermore, you accumulate equity in your rental homes, which you can sell later for a profit. If you're not a fan of managing your own properties, you can hire a management firm to take care of that for you or consider REITs, that is, Real Estate Investment Trust. A REIT is a business that owns and manages real estate properties and pays out the income to its owners. Many REITs are traded publicly on stock exchanges, but there are also private REITs that you can buy. REITs are one of the most reliable income-generating assets you can acquire, since they are required by law to return at least 90% of their earnings in dividends to their stockholders. Number 3, stock equities. The most well-known income-producing assets are traded on stock exchanges. When you own stocks, you have ownership or equity in that business. Stocks are an excellent investment since they require no ongoing care from you. You own the company and reap the benefits while others, such as the management team, handle the day-to-day for you. A really cool thing about stocks is that many established and financial solid firms pay out a percentage of their revenues or dividends to their stockholders simply for investing in them. These are popular among those seeking to live off passive income. I do not typically recommend purchasing individual company stocks as they are by nature highly volatile. Instead, you can buy a fund that gives you broader stock exposure. This is part of a good diversification strategy. There are several options to choose from, like mutual funds, ETFs, and index funds. As stated earlier, stocks tend to be high-risk investments. but they offer the possibility of significant returns over the long term. Number 4, U.S. government bonds. Bonds are an essential income-producing asset that every investor should own. They are basically loans to the U.S. government. Bonds tend to go up when equities decline and provide a more stable flow of income compared to other asset classes. They are backed by the U.S. government and are essentially risk-free as they are based on the credit worthiness of the government. They mature at various terms or tenors. U.S. government bonds are named based on the length of these terms. You have Treasury bills that are short-term investments and mature in 1 to 12 months. Treasury notes mature in 2 to 10 years, and Treasury bonds mature in 10 to 30 years. Bonds are typically more stable than stocks and have some guaranteed returns, but they have smaller returns. However, they are less volatile and could be depended on during tough times. You can purchase bonds directly from the U.S. Treasury, but it is much easier to purchase a bond fund. Number 5, index funds. Here are a few things you need to know about index funds that explain why they are so popular among investors. Index funds guarantee ownership of a wide variety of equities. They also provide greater diversification and lower your risk, and all this is usually at a low cost. Index funds allow investors to immediately diversify their portfolio. With just one purchase, you can own a bucket full of companies. For instance, if you own an index fund that is based on the S&P 500, you are actually invested in hundreds of companies. Just like stocks, indices such as the S&P 500 fluctuate, but over time have historically produced respectable yearly returns of roughly 10%. This does not mean that index funds make money every year, but over the long haul, they average around 10%. And apart from providing diversification and lowering your investment risk, many index funds charge very little. It is not uncommon to see funds with expense ratios that cost you $3 to $10 per year for every $10,000 you have invested. The lower the fees, the greater your returns. Number 6, ETFs. An exchange-traded fund, or ETF, is an investment vehicle very similar to index funds that I just spoke about. ETFs pool together the money of many investors to purchase a variety basket of securities. This basket could include stocks, bonds, commodities, and other assets. So investing in a single ETF exposes you to all of the underlying securities in that fund, which could number in the hundreds. ETFs have many of the characteristics of index funds in that they provide diversification, but unlike index funds, they trade like stocks. This means that you can buy and sell shares of ETFs like stocks on stock exchanges. One other important feature of exchange-traded funds is that they are often managed passively. They do this by mirroring the holdings of a specific index like the Dow Jones Industrial Average, or they may track an industry like technology, healthcare, and so on. Some examples of passively managed ETFs are the Schwab US Midcap ETF, Vanguard S&P 500 ETF, and Schwab US REIT ETF. Number 7, building a small business. Starting your own business is another excellent income-producing asset. This could be anything from having goods for sale on eBay to owning a fitness center. Your options are endless. Some businesses, like franchises and real estate investing, take a lot of capital, time, and effort before they become profitable. Alternatively, you could sell your skills online. As an example, if you are great at web design or writing, you could look for freelance work until you have enough clients to start your own firm. Building your own business can ultimately turn into an excellent income-generating asset. Be sure to do your research. Look at the needs in the market and get a mentor to help you with questions you might have at the beginning. If you've gotten value watching this video, hit the subscribe button you see below and like this video to get the most out of your money. And as always, see you next time.